the question at the end of the day was around the contradictions and complexities around the theories and concepts. And I guess I kind of got the high level understanding of what was it the agency cost of free cash flow was. Okay. But maybe if you just kind of went through that again, so I sort of just get a better understanding of exactly what it is.
Right. Should I just run through that? Would that be valuable?
Yeah. And I mean, if you've got a PowerPoint, that might actually be quite good just to see what's in it. Yeah.
Let me see if I can share it.
Yeah. I mean, I do get it at a very, like the high level concept of that, agency cost, but it's just kind of a lot to take in.
Right. Let's kick off with net present value. Did you get the concept of net present value? Because it doesn't make it particularly clear in the session.
No, actually, it's probably good. I did have to Google a lot of the.
Yeah.
I did a lot of Googling of the acronyms because there was also was it FCS or something? I can't remember them now. I'm just trying to look back through my notes.
Okay.
I was getting really confused. Yeah, FCF, free cash flow.
Yeah, well, gone on to that. Net present value. They use a lot of this stuff. It's really quite basic, to be honest. But they like everybody likes to. They sort of couch it in more complex terms. So net present value really is it looks at whether a project is going to be profitable for the company or not. And the reason they introduce it in the context of this session is because it's very relevant to agency costs. So as I put there, if you're a manager, if you're an agent for the company, which means a manager or a director, you really should be investing in positive net present value projects because they're the only ones that are going to add value to the business. So, that's simply all it is. There's nothing mystical about net present value. The rest of us in a small business would just call it a project and we'd work out whether it was going to make money or not.
Yeah.
So that was that one. And then we got the discounting capital. Now, that's a little bit more. Did you get the concept of that?
No, hang on.
Discounting, because when you've got a project which is going to take some time, you need to discount it because the cost of money at the point that you're setting the project up is going to be more valuable than the cost of the project in the future or the cost of money in the future.
Yeah.
So what you do is when you're working out the value of a project, you discount it using a particularly complicated formula, which I haven't shared with you, which you may have come across if you were Googling. And the problem with that is there is no common way of working out what the discount rate is. So many different companies will use different ways of using a discount rate. But essentially all you need to know is that you discount the value of the project and when you're setting it up by applying a formula because the cost of the money over time will reduce because you could use that money now and invest it and get a return on it, or inflation is going to eat away at it. So you have to have some discounted rate which gives you a more true picture of what the project value is going to be. So those are the two first things which you kind of need to know, but I wouldn't get too hung up on it, to be honest. It's only important in this context because of the agency costs, as I said. So free cash flow is the third thing. That is quite important, and basically it's just the money that's available after they've done all the investing they want to do. And there lies the rub, because what are the managers going to do with it? And they've got some choices, obviously. They can invest it in the business, which they prefer to do because it retains their power and gives them control, or they can give it back to the shareholders. And that's where agency theory and agency costs start to come in. So did you get all that from the session? It's not difficult, but it's not clear, I don't think.
Yeah, no, I think I did. Yeah. No, I think I'd covered those points.
That's great. I just wanted to make sure. It's a shame because you're private sector, aren't you? You're not public sector.
Yeah, I'm GSK. So
yeah, so this will all be very applicable to what you're doing. So it's very important to you. But I was hoping somebody from the private sector might join us because it's equally applicable to them as well. It's just dressed up in different terms. But I'm not going to do that because they're not here. And this is really what I've just said. If the cash flow, free cash flow is paid out to shareholders in the form of dividends, it reduces the money that's there for the managers to use in their pet projects, and therefore they lose control. And obviously the shareholders would rather have the money out as dividends or increasing the share value, and the managers would rather leave it in the firm to do the stuff they want to do with it. And that's agency theory, and that's where the agency cost comes in, because what the managers will do is, sorry, I should have gone too far, but what the managers will do will invest in any project that comes along in order to retain their control. So they may invest, I've probably said this later on actually, they may invest in negative net present value projects which don't add value to the business, and that's the agency cost. So the way that can be reduced, the agency cost can be reduced, is to increase dividends and debt issue. Increased dividends is fairly straightforward. Debt issue isn't quite straightforward. So how did you
That's
get
where
on
I
with
was very confused by the debt issue. Yeah.
Okay, let's have a quick look at that then. So debt issue is, it sounds as though it's going to be quite straightforward. In other words, you just borrow some money, but it's not quite as straightforward as that. So where it says debt issue, what it means is that the person or the company that's borrowing the money is the issuer. So they offer the debt to investors who buy the debt on fixed terms. So they know when they're going to get paid back and how much they're going to get paid back.
I see. Okay.
Okay, you got that? So the issuer is the lender and the person that wants the debt, and the investor buys the debt on fixed terms so that they know when they're going to get it back and they know the interest rate. So that is more flexible for the company because bank lending can be tied up in all sorts of onerous terms. So issuing debt by the company is a pretty good way of bringing into the company free cash. So the theory is that free cash motivates the managers because for some reason debt does, and I can see why that would happen, because if you've got debt hanging over your shoulders, you're going to be a bit more motivated if you've got lots of free cash that you've generated slotting around your bank account. It is I'll show you why. It's just gone to the next one. The theory is it motivates the manager. Usually so when you've got debt, you can repurchase stock, or when you use that, when you've issued debt, you get the money from the investors. You can use that to repurchase stock, and if you're repurchasing stock, that drives up the share price. So that makes the investors very happy. So that's the debt issue. Now, is that relatively clear?
I'm still quite confused because I think going back to this, I understood we were talking about when there's basically an additional cash flow, and to take out the agency cost, you borrow more money. Is that what you're saying?
Yes, essentially you do. Not from a bank. You buy it from investors, not necessarily shareholders, but from other investors. So it's I can't remember what the term is, but it's a promissory note.
Yeah.
So your own shareholders could buy some of the debt, or they could, it could be external investors. But essentially, what you're doing is you're bringing more money into the company, which motivates the managers because debt does that apparently. I'm not quite sure how, so don't push me on that one. But what it enables them to do is to live up to their promise with respect to free cash flow, because there's more of it. And buy back some of the stock, which drives up the share price. The same way as if you went out with five squillion quid and bought some GSK, everybody else would think that's worth buying and would buy it as well. So that drives up the share price. So that's good for the principals, in other words, the shareholders. So from their point of view, it reduces the agency cost. Because the agents, in other words, the managers and directors, are not wasting the funds, the free cash flow funds, on their own pet projects, net present value projects, which might be negative. Okay.
Yeah. Does this make sense to you? Because it just sort of like looking at it to me sometimes, trying to put it in the context of my own business, like where I work, maybe it's sort of like if there's a little bit of money, you might just squander it, but if you get a lot and you can do a lot with it, you spend it more wisely, especially if some of that's debt. Is that what it's sort of saying?
It is. I mean, to be perfectly honest with you, Danielle, I have some issue with the
Okay, good.
I have some issue with the concept or the theory.
Okay, good, because I thought it was just me being really
No, no.
stupid.
I mean, I'm what I'm doing here is going along with it because it's in
Yeah,
the
good.
module,
Okay,
and all you need to do is remember it and understand it, and you know, and put it down on paper. Now then,
cool.
my issue is that
Done.
I'm not entirely convinced that having debt motivates managers necessarily.
Yeah, yeah,
Okay,
yeah,
so that's my problem. As I put there, also the cons are too much debt can lead to bankruptcy, and that is the ultimate in agency costs. So you need to be careful with this. Um,
yeah,
but I absolutely get the concept that if you reinvest some of that extra cash flow into repurchasing stock, it's going to drive up the share price. I mean, probably not a lot, but it's going to make the share price go up, and therefore it's going to satisfy the principals or the shareholders. So I understand that bit. The bit I would want to argue with academically, and I'd want to research further, and I keep meaning to do it, is this idea that debt motivates managers. So that gives you an opportunity because in your submission, in your assignment, that would sort of stretch your it would demonstrate that you've researched further. So you
yeah,
could say, look, this is what the theory says, this is what the learning says, but I question that, and here are some of the things that counter that argument. Do you see what I'm saying?
yes, yes. That's good, and I will be happy to do that because I was
Yeah.
like, maybe I'm just being really dumb, but
No, I don't think you are. But from
yeah,
from a real life point of view, I wouldn't worry about it too much.
cool.
You
Okay,
know,
it's a nice theory then. In
hopefully
theory,
you're going to position one day when this applies, but by then
yeah,
you'll have a much greater understanding of it. So I think the theory is great. The point is, what is most important is the agency theory and how it works. So you
cool.
need to
Yeah,
understand that, and to understand that, you need to know about projects, positive value projects, negative value projects, and then to understand, you need to understand free cash flow and how that affects the projects because people want to spend on the projects, and you have to some extent understand discounting because the cost of money changes. And once
yeah,
you've got those three sort of sub things in your head, then you can start talking about agency theory, where there is a tension between the principals and the agents because they want to do different things with the free cash flow. Okay,
yeah,
that's great. Okay, so that's the increase in dividends. I mean, that's fairly straightforward, isn't it? I mean, managers, if the principals can persuade the directors or the managers to pay out free cash flow that might otherwise be wasted on negative MPV projects on dividends, then obviously the shareholder's going to be happy because they've got money in their bank. The cons against that, of course, if you increase the amount of dividends you're paying, um, this becomes an expectation in the markets and to shareholders. So if in the future you then have to reduce them back again because your free cash flow reduces, that's going to drive down your share price, and the principals, i.e. shareholders, are not going to be very happy. So those are the two things. So of the two, issuing debt and increasing dividends is by far the easiest one to understand.
yeah.
But the two ways are all about reducing the agency costs. Okay.
Okay.
Now then, there are also, I haven't put any slides about this, so have we covered that off in enough detail for you to be able to go back and have a look at it and understand it more fully, or do you want me to go over it again? I'm sure you don't.
No, yeah, no, I do get it. Yeah,
That's great.
it makes
Okay,
sense.
that's brilliant. There's a lot of stuff in there about stakeholders, which is fairly straightforward, I guess. Did you get through all that stuff?
Yeah,
Good.
yeah,
That's good. Okay. What else have I got here? This is interesting. I don't know whether you went on to this, but this might be something you want to include in your submission if you've got enough word space. According to the Companies Act, there are 7 key directors' duties, which I've put down there. Now, legally, as I put at the bottom, there's no requirement at all for the directors or the agents to maximise the principal's wealth. That is not one of the director's duties. So, although the theory says about it, and there is, people have been talking about it since the late 50s, early 60s, that the duties of the directors are increased shareholders' wealth. As legislation has progressed through common law and is now encoded in legislation, there is nothing which says that is the one of the directors' codified duties. Now you could argue that Section 172, duty to promote the success of the company, uh, uh, part of that is in that, but it might not necessarily be
Partly,
so.
yeah. Not
So
necessarily, yeah.
it's worth bearing that in mind, and it's also actually worth. This isn't in the session in any of the sessions, but I think it's well worth having a look at the legal framework, and that underpins the legal framework of the directors, i.e., the agents. And it's worth probably getting in if you can. That it doesn't actually say anywhere in the legal framework that one of the duties of the directors is to maximise shareholders' wealth. Um, as I said, you could argue that promote the success of the company um, is under that, but there's a good argument to say it isn't under that. That could be all sorts of things. But anyway, I just thought I'd chuck that in there because I thought it was quite interesting that it isn't in there. The maximising shareholder wealth bit. Okay, then we move on to the following week, which is all about the actual accounts, balance sheet, profit and loss, and cash flows. How did you get on with that?
Yeah, I think I followed a little like that a little bit more because in a sense, I've been following along with GSK's, you
Yeah,
know, accounts.
yeah.
Um,
I mean,
so there was
you're in quite a good position because GSK will have the sorts of accounts that all those ratios. I can't remember which document it is now, but it is quite a good piece of reading with all the ratios laid out in it, isn't there? Under
yeah,
5 or 6 different headings, I think. Did you
yeah,
read that one? That's worth actually it's worth probably printing out and keeping somewhere because if you're ever in a position to analyse a set of accounts, you can refer back to it, and it's got all the ratios down there that you possibly need. So that's a very valuable piece of learning that. Um, but underpinning everything, which I don't think is in the learning, is this accounting equation. Hello.
hello, hello.
So which is assets equal to liabilities plus owner's equity. So as I put there, everything the company has belongs to the owners or someone else. So that's it. So you can think it's stuff the company has plus other people's stuff plus the owner's stuff. That's all it boils down to. So
Cool.
all the accounts is to really drive that, and you can cut that up as many ways as you like. So most of the ratios, the acid test will bring in stock, but essentially that underpins all accounts. So I thought I'd stick that one in there as well. But I don't think, I mean, it might be boring, but I don't think there's anything in the second week on financial management which is particularly onerous. I think it's just a
Mm.
matter of understanding the different ratios and what they do. Um, is
Yeah.
that is that fair?
Yeah, that does sound about right. I mean, and I've got some people around me who I can ask questions to about that.
Yeah.
Um, Going back to I remember I highlighted some questions I had.
Yeah, fine.
So with going back to I guess last week's, there was a bit around like the four areas of divergence between the attitudes of stakeholders and things like the way the way financial performance is measured, the determinants of limits of capital investment, those things. How important are they to understand? Because I was a bit like, kind of get it, kind of don't, that sort of
Okay.
thing.
I mean, I haven't gone into that to be perfectly honest, so I
Is it
won't.
not that
It's no point.
important?
I mean, I
Gloss over
think,
it. Yeah.
to be honest, if you, I mean, there's two ways of looking at it, aren't there? It is important because hopefully your professional aspiration is to move up, either with your own employer or somebody else,
Yep.
and hopefully at some stage you'll be in a director's position. So you need to understand it. But for the purposes of your assignment and this course, then if you've cracked agency theory and you've applied GSK's accounts to the ratios, so you've shown that you've done some analysis of GSK's accounts using the ratios and applied your professional practice to the agency theory. So you've looked at what the conflicts might be within your own organisation.
Yep.
Then you are not probably going to lose much by not having in there those things.
Yeah.
But if you can make reference to those, then and you can demonstrate that you have understood it, then obviously there's no chance of you losing any marks. But there's no, let's be realistic here. You've got what 4 or 5 thousand words, and there's a
Yep.
lot of stuff to get in those 4 or 5 thousand words. So there's no possible way you're going to get everything in to the extent of being able to describe it, analyze it, evaluate it in your professional context, and then expand on it by doing further research. There's no way that you can do that in 4,000 or 5,000 words. So you're going to have to pick the stuff and as much stuff as you can that is most relevant to your professional development and to your organisation.
Yeah.
Does that make sense?
Yeah, because I mean, just looking at the question for this week, it says, identify contradictions, complexities, blah, blah, blah. And then it says, discuss the ways in which financial information impacts at different levels of an organization, e.g., a strategic cost-cutting exercise impacts different parts of an organization in different ways. So,
I think what I would do, if you've got the time, is to submit something through the Learning Journal on that.
Yep.
And
Okay.
I'll give you some feedback on it.
Yep, I can do that.
Is that okay?
Yeah, because I thought about, using, with GSK, the example we invest like billions in research and development.
Yeah.
But like obviously that's not great. What's great for our shareholders is if we make a blockbuster drug and it sells billions, but sinking billions into R&D and it doing nothing is a drain on the bottom line.
That's an excellent example of a NPV, isn't it? Net present value project.
Yeah.
This is a gamble, isn't it, with drugs? I mean,
yeah.
On balance, all the projects that GSK and its previous incarnations have done over the years, they've paid dividends. Not literally, but they've come out really well. They have paid dividends literally, but they've come out positive. But again, there's quite a few negative ones in there, aren't there, where the drugs have not been successful. But overall, the principals are prepared to invest because the projects have been very positive. So you can actually apply it quite well to your context, and it's quite an interesting context as well because of the amount that's spent on those projects or R&D projects, and the kind of gamble that has to be taken with them. So that's an interesting area. But yeah, I mean, if you want to put it through the Learning Journal, but even if you want, I mean, quite late on in the project, so there's not, if you want to just send me something by email, that's fine as well. If you do it through the Learning Journal and I haven't got back to you within a few days, let me know, because it either means that I need to kick up the backside or it hasn't come through. Okay.
Cool. Yeah. And just with the assignment, I mean, I know I haven't been great with the Learning Journal, but I'm good at taking notes, and then I'm like, consolidate them all into brilliant thoughts later. So that's where I'm at now, is the whole must have brilliant thoughts quick. But so with the assignment, are you still happy to review stuff from earlier weeks, or would you only want to review them from the most recent weeks?
Yeah, you didn't get a chance to submit anything with the formative date, did you? No, in fact, was it? I only
No, it was my email. Yeah, so the formative date was the 24th of July, I think. I completely missed that.
If you want to send something to me, Danielle, before the summative date, the final date, that's fine. Just do it by email. Just send me the Word document and I'll have a look at it.
Cool. Okay.
All right. It probably won't be formal feedback like I would normally. No. I'll just give you some pointers.
That would be good. Yeah. Even just to make sure I'm on the right track and at sort of the path. There's nothing gaping that it's like you will fail because you have not done this. And if you can get that to feedback, that'd be great.
It's a case of RTBQ, isn't it? I mean, it's very well set out in the in the module guide, and if you just follow what it says in the module guide, and you follow what I've been banging on about, which is give me a brief description of the item. In other words, I don't know, SWOT or something, or free cash flow or whatever you're talking about. So give me a brief description about that. Analyze it and evaluate it in your professional context, and then if you can, expand on it, which demonstrates you've done more research around the subject. Like we talked about just now with the what were we talking about, the debt issue and how debt motivates. If you show you've expanded on that, then that gives you extra marks.
Cool. Okay.
So yeah, to answer your question, more than happy if you've got time to fire me something over and I'll have a look at it.
Great. Yeah, because I'm really going to focus on that this weekend.
Okay.
And yeah, I mean, I've been trying to do it during the week, but I've got quite a few. I've got the sort of first 4 questions in the pipeline, and then obviously I've got the answers for this week sort of there. So really it's only missing like 2 weeks.
The reason I try and encourage people to use the Learning Journal and get feedback on it is because the Learning Journal questions very much follow the format that they suggest in the module guide.
Yeah.
So really, all you need to do is cut and paste is pushing it a bit, but you take what you've got, apply hopefully some of the feedback, and then you've got your submission. So it's really a way of writing the assignment over a number of weeks. But
Yeah.
not everybody works that way. People
I
prefer.
know. I must admit, I'm very good in winter with studying. I'm terrible in summer. I've really failed miserably with this paper.
Yeah, I know what you
Uh,
mean.
but
Uh,
I am, I am picking everything up now. I guess I'm more of a crammer than a slow
yeah,
and steady. I'm more of a stress helps me. So yeah, I'm doing well with that. Yeah, I know I've got, basically now less than 28 days to submit it, and yeah,
yeah.
I'm on
Well, that
track
should be
for that
plenty.
session.
I mean,
Yeah, it is. Yeah.
you've got. I think in terms of summer, you've got a short window now before the heat comes back. So,
Yeah, yeah, exactly. Well, I'm in Ireland actually at the
how are
moment.
you?
Yeah, for the weekend. Well, at a wedding, so it's actually raining. Yeah, it's raining here. You'll be surprised to know. So,
It's got
yeah.
getting quite. I'm in North Devon, so it's getting quite warm here. So,
Yes, that's good. Yeah.
okay. So, have you got any other questions?
Not at the moment. I mean, yeah, like I said, it was just sort of about the how to go with the assignment, but I
Okay.
think I'm on track for getting some good stuff together for the assignment.
Okay.
I'll put something together and submit it for you soon on this one.
Okay.
Yeah.
To be honest, I'm not worried. I mean, I've spoken to you on a number of, well, 2 or 3 occasions now, and I've seen some of your work. So,
Yeah.
I don't think you're missing the point.
Yeah. Okay, good.
I think you'll be okay, but just make sure you leave yourself enough time so that, you've got time to do a good job, and time for me to give you some feedback. Okay.
Yeah. Perfect.
Okay. As always, I'm around if you need to contact me, WhatsApp or phone or email or any of that. Can't promise to get back to you immediately, but I'll definitely try and get back to you within 24 hours. Okay. Good.
Perfect.
All right. Should we call it a day there?
Yeah, that sounds great. Thank you. Thanks for the
Oh,
call.
all right. Take care then,
All
Danielle.
right.
Bye now.
Bye.
Bye bye.